My name is Jennifer Gillespie. I'm the head of money markets at a company called Legal & General Investment Management in London. If you're trying to guess my accent, I'm a Canadian. The American comes next. You can hear the differences. I think you've listened to quite a lot of discussions, presentations. You may have read papers about CNAV money market funds. And I thought what it might be a really good idea is to remind ourselves what CNAV funds actually are, so that when we're having these broader discussions and when we're looking at issues that are coming up, we can understand where they're coming from, or from my perspective, why we're arguing against some of them. I guess to begin with, I should emphasize that I agree, unusual for an asset management, but I agree that it is correct to have regulations in Europe for money market funds, particularly those that introduce increased stability. In fact, I agree with many of the proposals that the Commission has put forward. I think that they will accomplish that stability as they have asked for. However, there is a risk that some of the elements might actually have the opposite effect. So I'm here to talk to you about the role that CNAV money market funds play in Europe. When I was sitting down to do my presentation, I sat down with my team and I said, if you could come up with 6 key facts about CNAV money market funds that we seem to forget from time to time, this is the 6 that they came up with. CNAV money market funds are about 50% of the money market funds that are domiciled in Europe, and that amounts to just over 450 billion euros. So they're not small, they're very large. The customers, or I call them investors, into CNAV funds include non-financial corporates, pension funds, and local governments. What the funds themselves invest in include charities, SMEs, and the public sector. CNAV money market funds are not banks. We've heard the discussion on shadow banking, but no one is suggesting that a CNAV money market fund is a bank. We do not do maturity transformation. We do not take depositors' money and lend it out for 5 years. We're not permitted to. Our assets match our liabilities, and we cannot be leveraged. We're not allowed to. And finally, the point that my team really wanted me to get across is that real people invest in these funds, and real people manage these funds. So they're not done in a black box approach or algorithms. So those are the 6 key facts, if we can remember that when we go through our presentation. So what I thought I'd then like to do is walk you through how one of these funds works. So a local government treasurer, hopefully you'll recognize the building. I'm told it's Brussels Town Hall. And luckily has 10 million euro surplus that she would like to put somewhere safe for a short period of time. She calls my team and asks them if she can put her funds into my money market fund. And of course, my team say yes. What she then does is she buys shares on the Irish Stock Exchange, each share being worth €1. She buys 10 million shares. What effectively that means is that my team now have 10 million euros to spend in the market to provide into the European economy. So what do they do with it? And here's the really not complex part, but I think sometimes we forget this. We lend it out to people. I'm going to try the pointer in the middle. We lend it out to people. So in this case, we have borrower A. I was trying to come up with interesting names. We'll say Austria. Austria. When we get to C, we'll do Canada. We lend out 500,000 euros to borrower A at a cost of 50 basis points. That's 0.5%. We use basis points in investment management speak. We lend that out for 30 days, and at the end of 30 days, Austria will repay us 500,000 euros, and the cost for them borrowing those euros would be 2,054. We keep doing this. We get to B. We'll call that Belgium. So we lend to Belgium 500,000 euros. In this instance, it costs 0.75% or 75 basis points. We do that for 30 days, and the cost for Belgium of borrowing it from us is 3,082 euros. This continuously goes on until we get to the bottom, and my team have spent the 10 million euros which the Treasurer has given to us. So now the Treasurer phones up and says, I'd like to know what the value of my share is, please. Do I get a dividend, and how am I going to do this? And this is where CNAV funds come into their own. We use something called amortized cost accounting, which is an internationally recognized way of valuing an asset under IAS 39 and FASB. That's the last technical bit I'll do for you. And what we do is we look at how much income we're going to receive from all of our investments. In this case, 40,000 euros, assuming that we spent the 10 million euros. What we then do is we divide the 40,000 euros by 30, because that's the length of time that we've lent all the money out. And we do a straight line amortization, so every single day, that local treasurer will get 1,333 euros. Not rocket science. That's called straight line amortization. In the case of a CNAV fund, we then bank that income for the treasurer. Should the treasurer sell her shares, that income is given back to her, and it is banked and moved off. So then the treasurer says, okay, well, what's the value of my share? Well, it's quite simple. We take the principal of the assets in our fund, and we divide it by the number of shares that are in issue. She bought 10 million shares, the principal is 10 million, and the fund comes in at a price of 1. So this is how these funds work. Now, this happens every single day. So the constant bit in it, the fact is, we keep doing this, and every single day, that's the price that comes into play. So that's how a constant NAV fund works. So why do our customers like it? Stability, access, and safety. Stability of price, remember the price is 1. Access, because they can use the fund every single day. That local government treasurer could buy or sell shares any day. And safety. Diversity of investments. We've heard a lot about diversity. I completely agree with the proposal that's in place and the credit quality of the instruments. So if these are why customers value CNAV funds, who uses them? Interesting question. The largest user of money market funds, the largest customers into these funds, are companies at 34%. But they're not just used by companies. They're used by other financial institutions, insurance companies, public sector, charities, universities, mutual funds, and pension funds. And then something at the bottom called distributors. A distributor is like an introducer to the fund. So some treasurers like to look at more than one fund at a time, and a distributor can compare the funds and contrast them based on various customers' requirements. So that's who uses money market funds. Who benefits from money market funds? The European economy. I thought you were waving at me, sorry. The European economy benefits from them. Let's take ourselves back to the 6 key points that I made at the very beginning. That's 450 billion euros, which was flowing into the European economy to fund companies, small to medium-sized businesses, and public bodies. We've given a few examples that you can see here. What if we didn't have money market funds? We think flight gap pressure. Remember, 450 billion euros. That funding could potentially leave Europe to find alternatives, not in VNAV funds, but into other jurisdictions. Without that 450 million, we would then have a gap for European enterprises, charities, and social infrastructure. Just as I showed you, that's who we invest in. Where would these charities and social infrastructure companies look to find more funding? The European banking system, which is already under pressure to not provide short-term funding for organizations, but to look at longer-term funding. So we think that we need to ensure that CNAV money market funds are available for use in Europe. I guess if I go back to what I said at the very beginning, that I emphasize that it is correct. I agree that we need overall European regulations, particularly those that provide increased stability to the European Union. There is, we think, better tools to deliver this policy outcome than the 3% capital buffer. And our 2 solutions would be gates and liquidity fees. Again, these will be things that you've heard batted around. They're quite simple, and in fact, gates already exist. Effectively, you limit the amount of money that can be withdrawn from the fund on any one day. Suggestion is a gate is operated at 10%. What this means is if you have large amount of redemptions, you can have an orderly exit out of your fund, creating stability in the market rather than having a run on the fund and all the money coming out. It's quite easy to use. I don't recall that it has been used. It certainly hasn't been used on the funds that I've done so far because we provide so much liquidity as it is. Another alternative is liquidity fees. This is what you call an anti-dilution levy. So effectively, it negates the first mover advantage. So if a client comes out of the fund and we don't put the gate down, and the cost of coming out of the fund is substantial enough, the client who comes out of the fund will be charged that cost, therefore negating being the first mover advantage. So hopefully I've given you a background on CNAV funds and how they work, and maybe got rid of some of the myths that are out there, because I think sometimes we forget that they aren't really that complex. And would invite any questions.